Hi, Sean Keenon here with the Legends Realty Group, and today we're going to talk about how rising interest rates could affect the real estate market and specifically the Atlanta real estate market. So to be clear, I have no crystal ball. If I did, I would have won the lotto many years ago and would be on a vacation on a beach or a cruise ship right now. That said, there's a great saying that goes, history doesn't repeat, but it does rhyme. Our real estate market here at the beginning of 2022 is still crazy. In fact, home values in Georgia increased by about 30% in the last year alone. So our market has been on fire and, in my opinion, overheated. The Fed finally is starting to raise interest rates to help slow inflation, and I honestly think they've waited too long and are going to have to shock the market by raising too quickly. The last I heard from the Fed is that they plan on raising rates by 0.5% in May and possibly another 0.5% in their next meeting after that, and about 1/4 point from that point forward. While the federal funds rate isn't directly tied to real estate rates, what happens is when that rate goes up, real estate rates tend to follow. All of this overheated market and financial concerns doesn't mirror the 2008-2007 bubble, but it does seem to have a lot of similarities. With all that said, I believe that the market will stay strong through this summer and into the fall and start to die off after that. At this moment, there are a lot of cash buyers out there already dominating the market, and some are still losing out to well-qualified buyers who require financing but are willing to overpay even more than the cash buyers are. Once interest rates get too high, which I think will happen over the summer, the market will likely still keep going until those cash buyers are all gone, and then we will soften towards the end of this fall as buyers who require financing start to soften. In my opinion, the extent to how much we soften, whether it's a plateau, gradual decline, or we just fall off a cliff, will likely depend on the appetite for real estate investment trusts. These entities are much more prevalent than they were during the last bubble and may buy a good amount of homes to add to their rental portfolios, as their rules state that they must reinvest a large percentage of their income back into the housing market. Unlike the last crash, they may also make deals to purchase a lot of the foreclosures that banks may end up with, even if the rate of defaults increases. That might absorb a lot of the bottom of the market. There are a lot of other unknowns that make it difficult to know for sure how far it will fall and decline. For example, no matter which political party is in office, and I'm not going to talk politics, but they all seem to want to kick the can down the road and make it the next party's problem. Everybody wants a great economy while they're in power. And our government has gotten used to interfering with the rights of companies to collect money that's owed to them, so they might step in. For example, the moratorium on evictions during COVID for renters and the current continued pause on student loan payments. With all of that said, I believe that no matter what, the peak will be this summer, and the only unknown is how far and how fast we fall. So if you plan on selling and cashing out, this might be the best time to do it. I only recommend this if you are possibly cashing in on profits and understand the tax consequences of a second home or an investment property. Trying to time the market with your primary home and rent for a while is definitely not advised. As much as I'd like to help you sell your home and make some money, I don't think that's a smart move. If you are selling and buying another home, it doesn't really matter what time of the market you plan on doing this, since you are simply exchanging which home you're going to ride the real estate wave on. It's still going to go up and down with whatever home you own. If you are buying a home, please don't be fooled. You will likely have a very similar payment on the less expensive home, as the rising interest rates will make your payment higher on a lower purchase price. The difference is that you may get a lower loan amount and be able to maybe refinance into a better rate once rates fall again and enjoy the increase in home values as the market rebounds. If you really need to purchase a home, perhaps now is the best time to still try before rates get crazy. But if you can wait, I would personally suggest you do so. I know that sounds foolish coming from someone who makes money by helping people buy and sell homes, but I do my best to do what's right for my clients, regardless of how it affects my income. How does this affect Atlanta and the surrounding suburbs in particular? Our market has been better than many others as far as appreciation goes. We've been, again, one of the hottest markets in the nation. Therefore, I believe it will take a little bit longer for the market to shift and to affect us in our area. The good part about that is that this means we may have a chance to get some clues as to when it will start to turn here, as there will likely be declines in the national numbers before we see it locally. Just be aware that in our last bubble, the markets that went up the most and were the hottest also fell the most and crashed the hardest. So, if it crashes, it will crash harder in Atlanta and the surrounding areas than most likely the national average. To sum it up, I do believe that we will likely see a 25% decrease in home values over the next year or two, with the possibility of up to 50% if we have a recession. I hope you found this video helpful. If you did, please make sure to hit that like button and give it that thumbs up, and subscribe so you don't miss out on any future videos. I put out at least one new video each week. Thanks for watching, and I'll see you again soon.